this is John Kvale, and this is our December capital market and financial planning review, and this must be take 22. Not quite that many, but it's a lot. So hope you enjoy, and I hope this finally comes out well. As mentioned, this is the last monthly review of the year. Those of you that are watching, I just scrolled down to the body of the text from the pig that's talking about the Roth and the 401k. Let's jump right in. We do this in a digital video, audio, podcast format. I do this to give a little bit more granularity on what's going on, and I find that it usually helps me clarify, and we get a lot of good comments back. We do this on a monthly basis for all the newbies. So if you're driving down the road listening to this in a podcast-like format, please keep your hands on the wheel. First, I'm scrolled down to the 401k rules that have changed. So if you made $150,000 in 2025, and you're age 50, and you start hitting those catch-up rules, those are not going to go in as pre-tax. Those are going to go in Roth. We're going to touch everybody that this affects, so sometime throughout the year. The employer is supposed to make these cut over appropriately, and we hope that happens, but we'll double check. But essentially, we're going to end up, everybody that falls into this situation, we're going to end up with a mandatory Roth bucket in our 401k. The trick on this is that we'll now have two buckets, and when and if we eventually want to roll that over, we're going to need to have a Roth account opened at the same time this year in order to keep some certain 5-year lookbacks from happening. I put that in the post here, and I will discuss it more throughout the year, but just wanted to give everybody a heads up. And this came from the field. We had about a half a dozen people reach out to us and say, hey, what is this? And so thank you guys very much. Now moving on, we're going to go to the capital market comments. And man, I kind of put this when I was doing the post for this. The Federal Reserve got jiggy in December. In this post here, which I'm highlighting over, we talked about quantitative tightening stopping. Quantitative tightening is essentially the runoff of the Federal Reserve's balance sheet. Recall they bought bonds from 20 to 22, and then they pivoted and went the other way and said, oh, we're going to raise rates, and we're going to let those bonds run off. So quantitative tightening, as opposed to easing, is letting those bonds run off, which essentially they mature and they're taking money out of the system. So we can see what their balance sheet is. I pulled this from the Federal Reserve information. Then, getting jiggy with it, later on, the Federal Reserve lowered rates. Now, these are two different things. So recall, the Federal Reserve has a bank. They have the ability to buy. They are a bank. The Federal Reserve buys and sells to adjust monetary policy, and they also can control interest rates. So I scoped down real heavy to get this picture. That those of you that are in drive listen only mode, I have basically the Fed funds rate peaking out. If I backed up from this to the 10,000 or 20,000 foot level, this looks like a blip, but I scoped into it so we could see. So in December, the Federal Reserve lowered about 25 basis points. This affects short-term interest rates, think your money markets and things of that nature. It doesn't affect long-term rates, but their hope is that it will pull down long-term rates. And that long-term rates are predominantly the most important thing are mortgages. No, so okay, this is a net positive. Number one, I'm scrolling back up for those of you that are in listen-only mode. We stopped letting the balance sheet run off. They lowered interest rates. Number two, this is why they're getting jiggy. By the way, this is the link to here to the post it gives you greater clarity on this. And then number three, they announced RMP. I don't know why they do all these acronyms, but they do. They announced Reserve Management Purchases. The Federal Reserve has a piggy bank too, and their piggy bank is running a little bit low. This is the Federal Reserve's assets. They're running low. They're wanting to build that back up. So they're not only going to they stop letting runoff, but they're going to purchase more bonds, which is a positive inflow. It's the exact reverse of quantitative tightening. It's a subtle quantitative easing. They're going to do this to the tune of about $40 billion a month through April so far. Those are three big stimuluses here. Less negative from the quantitative tightening, lower interest rates, and more, and a flip-flop basically, more purchases. These are positives. Those that are in listen-only mode, I'm scrolling back to the top to the silly image of the new catch-up rules that's going to be in the post. That's it. farewell 2025. It was a good year. We all enjoyed it. We look forward to a great year in 2026. We're going to go over a lot of this in our tax-related newsletter, which is off the quarterly grids now, per our editor. It also helps us because quarter ends are very busy. Thank you all. We appreciate it. Once again, it was a great year. Everyone new that's listening to this, we thank you for your time. This is running just about over 5 minutes. Thank you so much. Take care.